Order block or fair value gap, which provides the optimal entry for smart money traders. The right choice often comes down to the asset in focus and what aligns best with your trading style. Today, however, we'll provide key insights into both entry methods that could significantly benefit you. In this video, we'll begin by breaking down the ideas behind fair value gaps and order blocks thoroughly. We'll go over the guidelines for spotting reliable, high-probability order blocks and fair value gaps. Explore the strategies involved in trading with order blocks and fair value gaps. Lastly, we'll disclose our selected approach and the reasoning psychology supporting it. If that catches your interest, make sure to tap the like button and subscribe if you're visiting the channel for the first time. We'll see you right after the intro and disclaimer. We're looking at a bearish market structure. The sharp drop was driven by a major buyer-seller imbalance during the latest impulse move. This supply-demand disruption becomes visible through the creation of fair value gaps, a space formed between the wicks of 3 back-to-back candles. At this point, the price is inefficient on the sell side, increasing the probability of it revisiting the gap zone to restore market balance. Fair value gap zones may vary in size and quantity during a single price swing. Every gap requires a tailored method when attempting to enter the market using a defined strategy. As an example, we might spot a minor fair value gap close to a swing low. Entering at this FVG level and positioning the stop just beneath the swing low provides a favorable risk-reward setup, with the target aimed at the candle closes. This structure forms a strong trading scenario. The stop is securely located below the swing low, while the target is the recent high, which remains a realistic objective even if the market begins to pull back. In another scenario, we encounter a significantly wider fair value gap zone. Entering at the beginning of this zone increases the chance of getting stopped out. Even positioning in the middle doesn't improve the risk-to-reward ratio enough. The goal is always to engage in trades that deliver a risk-to-reward greater than 1-to-1. So what's the best way to handle the market in this situation? With broader trading zones, it's ideal to let price move into the zone first, then shift to lower time frames to identify more precise entry opportunities at a better value. On those lower time frames, the correction often appears as a short-term downtrend. In such cases, we wait for clear indications of a reversal before entering the trade. In our final example, we observe several fair value gaps within a single impulsive price movement. The main question becomes, which FVG should be selected? The strategy is to allow price to reach these zones and then scout for buying setups. Yet, our focus is limited to just 2 specific areas. Why not consider the first zone? By marking the beginning and end of the recent impulse and applying a retracement tool, it's clear that the 2 targeted zones fall below the 50% threshold, the discount region, whereas the other FVG sits above it, placing it in the premium area. Our preference is to look for buy setups only within the discount zone, and there are solid reasons behind this approach. One major reason is that early buyers often get swept out by the market. A safer tactic is to hold off until the price moves into the discount zone before initiating a trade. This method boosts the probability of success and lowers the chance of falling victim to a liquidity sweep. Up to this point, we've explored fair value gaps and how they can serve as strategic entry points across various market setups. Let's move on to order blocks. The question is, how can we spot high-probability order blocks on the chart? Once fair value gaps appear on the chart, we identify the candle responsible for the imbalance as the order block. This candle is seen as the point where key decisions were likely made. Just like FVGs, when price revisits these zones, there's a strong likelihood of rejection, presenting a solid trading opportunity. Order block candles also vary in shape and size depending on the chart. When dealing with a narrow order block zone, it's often wise to allow a bit of extra room in that demand area or plan for a wider stop loss when placing a buy limit. That's because, while order blocks are highly effective tools, price doesn't always respect the exact edges, so it's important to remain practical with entry and stop placement. In contrast, with a broader order block zone, it's better to switch to lower time frames to look for confirmation signals and enter at a more favorable level to maintain a balanced risk-to-reward ratio. All that said, after extensively backtesting both order blocks and FVGs across various currency pairs, we've found they tend to deliver strong results when specific conditions are met. Let's go over 3 key rules for spotting high-quality entry setups with FVGs and order blocks. Rule 1. ensure alignment with the overall market trend. Determining the market's direction is typically the initial step in price chart analysis. The goal is to recognize the prevailing trend and assess whether bulls or bears are currently dominant. It's crucial to trade in harmony with the active side of the market. When order blocks and FVGs line up with this directional bias, the entry signals tend to be more dependable. In a well-defined trend, identifying structure points, swing highs and lows, and trade opportunities become straightforward. But if the chart lacks clarity on market control, it's often smarter to shift focus to a different asset. Rule 2. Targeting areas where liquidity has been accumulated. During chart analysis, we view classic support and resistance zones as liquidity pools, particularly areas with equal highs or lows or repeated rejections, as these act as major liquidity targets. But why does spotting these liquidity zones matter? Liquidity plays a critical role in driving market price action. It's essential to grasp that price often gravitates towards zones rich in liquidity. On the flip side, once liquidity has been absorbed, the market usually shifts away from those levels. Keeping that in mind, liquidity grabs often occur before price reaches an order block or FVG, and these crucial zones can trigger strong rejections, which is why locking in partial profits before price touches them is a smart move. Rule number 3: confirmation through a market structure break. A break of structure happens when price breaches a level that once acted as a barrier, causing a rejection of price movement. So, what does this indicate from a price action perspective? It suggests that the impulsive move responsible for the breakout wasn't just a short-term reaction, but rather a signal of strong momentum and the potential for trend continuation. A demand zone that triggers a breakout becomes a more significant signal. By combining a break of structure with order blocks and FVGs, we can pinpoint areas where momentum is confirmed, providing a stronger foundation to enter the trade. Now we arrive at the final and most crucial segment of this video: order blocks versus fair value gaps. Which one do we personally prefer? To answer that, it's essential to understand that both entry methods can be effective. The better choice depends on factors like the asset you're trading, your preferred entry timeframe, your trading approach, and ultimately what aligns best with your strategy. Order blocks might offer more precision for certain pairs, while FVGs may yield better results for others. That's why it's important to backtest each setup on your selected asset to evaluate performance and build confidence in your trades. As for our preference, we personally favor entering at order blocks over fair value gaps for several key reasons. Let's walk through a real chart example. We're looking at the EUR/USD pair on the 1-hour timeframe. The most recent impulsive leg broke below a key level, signaling strong bearish sentiment and increasing the probability of continued downside. This movement resulted in two fair value gaps, and we've highlighted the candle that initiated these imbalances as our order block zone. Each of these regions can serve as potential supply areas where we might look to enter short positions. Given the intensity of this drop, entering a sell trade immediately is not ideal. A smarter approach is to wait for a retracement and seek entries at more favorable levels, keeping a solid risk-to-reward ratio in mind. The key takeaway here is that regardless of where we choose to enter, our stop loss should be placed above the order block candle to protect against price volatility. For the first take-profit level, we can target the close of the imbalance candles, since, even in the event of a reversal, we anticipate price will revisit that level. Now, if we apply a Fibonacci retracement on the recent downward leg, we'll see that only one of the fair value gaps falls within the premium zone. As we've discussed, our interest lies in selling from premium, not discount levels. Therefore, we can confidently disregard the lower fair value gap from our trade setup. Now, if we were to set a sell limit at the fair value gap zone, there's a higher chance the price would trigger our trade. However, the challenge is that in order to protect our position, we'd need to place the stop loss above the candle that created the gap, resulting in an unreasonably large stop. Even placing the entry at the midpoint of the FVG doesn't help much, as the stop would still be wide, ultimately hurting our risk-to-reward ratio. If we attempt to use a tighter stop loss, it would fall within the supply zone itself, an area that carries significantly higher risk. Even if we zoom into lower time frames to seek confirmation before entering at the FVG, the odds remain unfavorable. There's still a strong likelihood of getting caught in a liquidity grab, making the setup riskier than it appears. With that in mind, a more conservative and calculated approach is to place our entry at the beginning of the order block zone. We position our stop loss just above the candle that initiated the impulse move and set our target at the close of the most recent market structure. While order block entries offer strong confirmation and a solid risk-to-reward ratio, the downside is that they might cause us to miss trades that react earlier, often at the fair value gap. Still, we favor this method for its reliability, choosing precision over chasing every setup. The key takeaway here is that mastering the discipline to wait for high-quality trade setups, while filtering out the low-probability ones, is an essential skill that separates consistent traders from the rest. With that in mind, patience isn't just a virtue, it's a strategy. Here's a list of the pros and cons of entering at order blocks versus FVGs. Now let's look at the New Zealand dollar on the 15-minute chart. In the context of a strong downtrend, the latest impulsive move has left behind a fair value gap. We identify the candle responsible for this imbalance as our order block, anticipating a potential bearish rejection if price pulls back into this area. Since we're working with a wide trading zone, there are two viable strategies: zoom into lower time frames to refine our entry at a better price, or keep it simple and place our entry at the close of the impulsive candles. For this example, we'll go with the second option. Given the clear bearish momentum, there's a higher probability that price will tap into the fair value gap and continue downward. In strong trends, pullbacks are typically shallow, but as momentum fades, deeper corrections become more likely. Let's see how this trade would have played out. If we had taken the entry directly at the fair value gap, there's a high chance we would have been stopped out due to price volatility. But by waiting for the price to reach the order block, we were able to position our stop loss more safely, just above the candle that initiated the move, giving the setup more room to breathe and ultimately protecting the trade. Moving on, the latest impulse created another fair value gap and order block. Applying the same strategy, we placed another entry. While the price initially reacted slightly to the order block zone, the strong bullish momentum eventually pushed through the supply zones. So, whether we entered at the FVG or the order block, this trade didn't play out in our favor, it was a loss. Still, if you're well versed in smart money concepts, you'll likely spot another setup forming on this chart. We're identifying this swing point as the start and this one as the end of the latest move, followed by a weak breakout. Right around that breakout, we notice equal highs, which immediately signals a liquidity hotspot. The long wicks here tell us shorts have been activated, and stops are likely stacked just above those highs. Now, here's the alpha. To the left, we spot a fair value gap and an order block, positioned right above the liquidity zone. That's a prime smart money entry setup. Price just swept the equal highs, grabbed liquidity, and is now approaching the order block. This is where smart money traders expect rejection. Trade setup, sell limit, inside the OB zone. Stop loss, above the swing high. Target, the bullish order block just below. Why? Because once price hits that zone, it's a key decision point. Bulls may take over, so we aim to secure profits there before market direction flips. Key takeaway, we're aligning with three core principles: liquidity sweep, OB rejection, and targeting the next key support zone. That's a textbook SMC setup with a proper R. Once the price taps into that zone, it's crucial to watch price action closely before making your next move. Now, as shown, the third setup worked out well, whether you entered at the FVG or the order block. However, the order block entry offered a tighter stop and better risk to reward. On this trading day, we ended with 1 loss and 2 wins, both winners delivering an R greater than 1-to-1, a solid outcome. That said, real trading isn't always this smooth. You'll face losing streaks, and that's exactly why a strong risk management plan is non-negotiable. It's the only way to survive those tough days and stay ready when the market turns in your favor. If this video helped you level up your trading game, smash that like button to show some love. And if you're new here, hit subscribe. We dive deep into advanced trading strategies every week. Catch you in the next episode. Hand waving.